On the 10th day of July 2025 in Commissioners' Chambers. We will begin with a roll call. Mr. Secretary, would you give the roll?
Absolutely. President Pleshnik.
Present.
Commissioner Beveridge.
Here.
Treasurer Zurin here.
All in attendance. Our first item of business is approval of the minutes of our meeting of April 17th, 2025. Do I have a motion to approve, waiving reading of the same?
Move to approve.
Second.
With a motion and a second, all in favor say aye.
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 It's unanimous. The minutes are adopted. Do we have any old business before the committee? Any old business? Hearing none, we'll go on to new business with our investment review.
Thank you and good morning. Really appreciate always the opportunity to provide an update on what we're seeing in the marketplace as well as an update on the county's investment portfolio. So again, as we had mentioned last quarter, there's a fair amount of uncertainty, but clearly with the passage of the big beautiful bill by the current administration, that removes at least one element of uncertainty. So our lake of uncertainties is getting smaller, and clearly the most prevalent one now, as we see it, is what the position that the Federal Reserve is taking. So when we think in terms of course, interest rates, the big driver is what the Fed does. The Fed makes their decisions based on the data as it relates to inflation and employment, and then of course that impact on economic growth. So the current overnight rate is still in the range of 4.25% to 4.5%. Fed met mid-June, and Fed Chair Powell has been very much kind of stuck his heels in the mud here, we would say, that he feels that they should not lower the rate until they see the impact potentially on inflation due to tariffs. So there seems to be a change in shift here at the Fed, rather than just looking at the data as they know it, looking at the data that they think may be forthcoming. But that being said, the prognosis is to continue to expect 2 additional rate cuts in 2025. That was communicated also by the Fed in their updated economic projections that they issued in with their June meeting. That's also been communicated in speeches and testimony as well. We've also have started to see other members of the Fed who were perhaps in the camp of keeping rates where they were, starting to be more open to lowering rates. So that being said, the expectations are that we will have that next rate cut at the September, if not September, the October meeting, and then the final rate cut this year at the December meeting. Again, 2 25 basis point cuts in rates. That would put that overnight rate down to 4. That would impact funds that we currently have in the portfolio that are very liquid, that are subject to, of course, that overnight Fed funds rate. So, of course, inflation being the big key, like we said, that the Fed is focused on. Inflation has been relatively modest throughout 2025. And yes, there is the unknown what the impact on tariffs will be on inflation. But the expectations are that any impact on inflation won't be long lasting because, again, when we look at how the inflation numbers are calculated, it's comparison of prices today compared to prices a year ago. So they eventually fall out of those calculations. But that being said, even if we get a little bit of an uptick in inflation, unfortunately, we feel that will fuel the Fed to continue to keep that rate higher. And these higher rates have are having a drag on economic growth, particularly when we look at the consumer. But I think the key point is when we received the first quarter of 2025 GDP number, which reflected a negative 0.5%. That was rather, I want to say, misleading because it was the result of businesses, what we would say, front-running the potential tariffs by stocking up their inventory. So it resulted in negative growth, and that negative growth is expected to reverse itself this quarter. But overall, the expected growth for 2025 is subpar growth overall. So clearly, the higher interest rates in the short term are squeezing the U.S. economy. They are more restrictive than perhaps they need to be, but that's the world we're living in. And when we talk about how restrictive they are, we can look at things like the consumer credit card delinquencies. Those are up from about 8% 2 years ago to around 15% delinquencies today. The growth in the delinquencies has been at a slow pace, but it's still on a collective, cumulative basis, is rather significant as well. The unemployment numbers have stayed stable. We had unemployment at 4.1%, but somewhat a little bit misleading, because when we look at how the unemployment rate is calculated, the denominator, kind of getting in a little to the weeds here, but the denominator is the labor force, and the labor force has decreased as a result of things like reduction in the immigrant population, and so that has resulted in the that denominator being smaller, which allows for, even though we've had very slow growth, job growth has contributed to the unemployment rate dropping slightly to 4.1%. So there's been a lot of events occurring throughout this quarter, and that has contributed also to the continued volatility in interest rates. When we look at really where the market expects the overnight rate to be in 26, so kind of looking a little further forward, we can see on this chart, which looks at the market's expectation for the overnight rate at the end of each year, and the kind of a timeline of how those expectations have changed. We can see in 2026, the blue line on the bottom, market is expecting that rates will be below, closer to 3%, bouncing off of 3%. Inflation, quarterly basis, has been below the Fed's target, but on an annualized basis, as it has been at 2.7%, and that is really one of the numbers that the Fed is focusing on, is that annual level of 2.7%. This is talking just about the consumer real briefly. We're looking at the retail sales numbers, which have been fairly steady here. Definitely nothing to be concerned about as far as any material drop in retail sales. The consumer is still spending, but as we said, the consumer is spending by utilizing their credit cards, and unfortunately, those delinquency rates have increased at this point. When we also look at the jobs number, the labor market, we're also looking at the claims for unemployment. So we're looking at the initial claims for unemployment. This morning, the numbers came out. They were, I think, 224,000, somewhat in line with expectations. But clearly nothing from a trend standpoint to be a red flag to indicate that companies are, cutting back on workers at this point. But the other point that is kind of key in the equation is what's happening with the continuing claims, which is where when folks are unemployed and they're receiving unemployment benefits, how long is it taking them to find a job? And we can see that those numbers have increased a bit. So that's a sign that it is a little more difficult to find a job when you have lost your job. And of course, that feeds into consumer behavior. And as we know, consumer activity represents 2/3 of the U.S. economy's activity. Talked briefly about the volatility in rates, and we can see that here, looking at the 2-year Treasury and the 5-year Treasury on the left-hand side. Still at levels that are aligned with where rates were prior to the great financial crisis back in 2008. So that continues to present opportunities. And then particularly when we look at the 5-year yield and we look at that 5-year Treasury on an average basis, where we're at here today, so far this year, is definitely still an opportunity relative to, again, that pre-housing crisis time. We look at where rates are today. This is pretty much where we're at. We have 5-year at 3.92 and the 2-year at a 3.86. So this all, of course, plays into investments for the county. Of course, though, we have to take into consideration the upcoming cash flow needs for the county as well, and of course with the Safety Service Center project underway and the debt associated with that, that is also playing into how we have the portfolio structured in conjunction with the county treasurer. We can see that at the end of the quarter we had $183 million in cash. and $259 million in securities. The cash piece is a little high just because Treasurer has been able to take advantage of some local bank opportunities that provide a above market return for cash. So we have kind of shifted some funds from securities into cash. Overall, the weighted average yield is at 3.57%. We have a weighted average maturity of 1.72 years. And we can see the maturity distribution on the bottom, which also includes the yields on those maturities in those securities maturing within each maturity bucket. And the portfolio remains diversified across the securities that are permissible under the county's investment policy. And as we have taken advantage of some short-term rates, we've been more active in the commercial paper and corporate bond markets as well.
I'd like to just thank Eileen Stanek and Meter for all their work on our portfolio. We really we're very diligent in watching the market and all the opportunities. We've really focused on corporate bonds, commercial paper, and going out to the local banks and trying to get them to bid for investment in CDs and savings accounts. We recently had our last CD that was paying over 5% mature, so we had to reinvest that. But a lot of times the local banks are very eager to get an investment from the county, so you know they often pay a higher yield, a higher return on a CD or a savings account, and we're constantly looking for that and constantly working with local banks. And I also have to say, when I evaluate the portfolio, the return is actually above last year's return at this point. If you look at the June 30th return, which is fantastic, and that's with taking the safety center funds out of the investment return. We're still ahead of schedule from last year, so we're doing really well. The other thing we're really watching. We still have a few treasuries that we purchased about 4.5 to 5 years ago. They're getting ready to mature. Those are a very low return. So when we reinvest those, you know, the return may go from less than 1% to hopefully the market rate, which is over 4%.
Yeah, 4%
so we'll
plus.
see a little boost there. So we're watching the portfolio very closely and looking for every opportunity that we can. And once again, thank you, Eileen, for all your help with this.
Well, you're welcome, and thank you for the collaboration. It's a team effort, certainly.
Thank you. Any more discussion in new business? Any questions for Ms. Stanek? Hearing none, I would entertain a motion to adjourn.
Move to adjourn.
Second.
All in favor?
Aye.
Aye.